Record-keeping requirements for taxable and exempt persons under UAE Corporate Tax Law. Under the UAE Corporate Tax Law, both taxable persons and exempt persons are obligated to maintain records and documentation to support their tax filings and demonstrate compliance with the tax law. This requirement is not only crucial for ensuring proper tax reporting but also plays an essential role in facilitating audits or reviews conducted by the Federal Tax Authority, FTA. The law specifies a retention period for these records, which must be adhered to for a defined number of years after the end of the tax period to which they relate. This article explores the record-keeping obligations for both taxable persons and exempt persons, detailing the retention period, examples of records that should be kept, and the responsibilities of maintaining these records in an accessible format. Retention period for records. Taxable persons and exempt persons must keep their records and documentation for a minimum of 7 years from the end of the tax period to which the records relate. The tax period refers to the time period during which the transactions occurred and when the income or expenses were recorded for tax purposes. Importantly, the 7-year retention period applies to the specific tax period in which the records are relevant, not necessarily the tax period in which the records were created. For example, if a taxable person uses the cash basis of accounting, which records transactions when payments are made rather than when they are invoiced, certain documents such as invoices or bills may relate to a tax period in which the payment is made, even though the invoice itself was issued in an earlier tax period. In such a case, the 7-year retention period starts from the end of the tax period when the payments were made, not when the invoices were raised. This ensures that the tax records reflect the actual cash flow for tax purposes and are retained for the correct duration in line with the corporate tax law. Types of records to be maintained. While the corporate tax law does not prescribe an exhaustive list of records that must be kept, it does make clear that taxable persons and exempt persons should maintain records that support the information provided in their tax returns or any other documents submitted to the FTA. These records should enable the FTA to easily ascertain a person's taxable income and verify their tax filings. Typical records that must be kept by taxable persons and exempt persons include, but are not limited to, financial statements. These include balance sheets, income statements, and cash flow statements that reflect the business's financial performance and position during the tax period. Invoices and receipts. These documents provide evidence of sales and purchases made during the tax period, particularly relevant for calculating revenues, expenses, and deductible items. Bank statements and transaction records. These records are crucial for tracing cash flows in and out of the business and reconciling them with other accounting records. Contracts and agreements. Any contracts or agreements that are relevant to the business's income, expenses, or liabilities should be retained. This includes sales agreements, lease contracts, and employment contracts. Purchase and sale ledgers. Detailed records of purchases and sales, including the parties involved, the amounts transacted, and the dates, are essential for calculating taxable income. Inventory records. For businesses involved in the sale of goods, inventory records showing stock levels at the beginning and end of the tax period, along with any purchases or sales during the period, must be maintained. Liabilities and loan documentation. Documentation related to outstanding debts, loans, or other financial obligations of the business should also be retained. Other relevant business correspondence. Any other correspondence, such as notices from regulatory authorities or communications related to business operations, must be maintained. While these examples provide a general overview, the specific types of records required may vary depending on the nature and complexity of the business operations. However, it is important for both taxable persons and exempt persons to ensure that their records provide a comprehensive and accurate picture of their financial activities and comply with the corporate tax law requirements. Accessibility and submission of records. It is essential that all records be readily accessible to the FTA upon request. The FTA may ask for any additional documentation or records to support a taxable person's or exempt person's tax filing, such as financial statements, accounting records, and evidence of compliance with the law. As such, taxable persons and exempt persons must ensure that these records are well organized and stored in a manner that makes them easy to retrieve if the FTA requests them. Records may be maintained in various formats, including paper or electronic formats, as long as they meet the necessary requirements and are accessible to the FTA. For example, businesses may choose to scan and store receipts or invoices electronically, as long as these records are clear, legible, and easily retrievable when needed. Responsibility for record keeping. Both taxable persons and exempt persons are responsible for maintaining their own records. The responsibility includes ensuring that the documents are accurate, up-to-date, and properly stored. If any documents or records are lost or destroyed, the person or entity may be required to prove the validity of their tax filings through alternative means, which could be more difficult. Furthermore, if the FTA requests records from a taxable person or exempt person, the entity is obliged to submit the requested information within a reasonable time frame. Failing to comply with such a request could result in penalties or other enforcement actions under the Tax Procedures Law or the Corporate Tax Law. Penalties for non-compliance. Failure to comply with the record-keeping obligations can result in penalties, as specified under the Corporate Tax Law and Tax Procedures Law. These penalties include AED 10,000 for the first violation of the record-keeping requirement. AED 20,000 for each repeated violation within a 24-month period from the date of the last violation. These penalties are intended to ensure that businesses and entities take their record-keeping obligations seriously and that they maintain adequate documentation for auditing and tax reporting purposes. Record-keeping requirement. For more details, contact us.